Did you know that millionaires who earn their wealth are only moderately happier than those who inherited it? Or that spending money on others can bring more joy than spending it on yourself? Money isn't just about numbers. It's a psychological journey with twists and turns that can baffle even the brightest minds. Today, we're exploring the psychology of money and uncovering 20 powerful lessons from Morgan Housel's groundbreaking book. From the strange ways we think about wealth to the emotional reasons behind our financial decisions, we'll unravel the mysteries with real-life anecdotes and hard-hitting data. Every financial decision we make is filtered through our own personal experiences, which are unique as our fingerprints. Take, for example, the story of two investors, one who lived through the Great Depression and another who grew up during the booming 90s. Their investment strategies are worlds apart, not because one is irrational, but because their experiences have shaped their perception of money. Personal experience often trumps what traditional financial models would predict. The line between making it big and losing it all can be as thin as a lottery ticket. Consider the dot-com bubble, a time when luck made millionaires overnight and risk left many in ruins. Historical data shows that the Nasdaq Composite reached a peak of 5,048.62 in March 2000 before plummeting to 1,114.11 by October 2002, a stark reminder that luck and risk are two sides of the same coin. Greed can turn success into failure by moving the goalposts. John D. Rockefeller, the world's first billionaire, famously answered just a little bit more when asked how much money is enough. This insatiable appetite for wealth can lead to a cycle of never-ending pursuit where satisfaction is always just out of reach. It's crucial to define enough and stick to it. Albert Einstein allegedly called compound interest the eighth wonder of the world, and for good reason. If you had invested $1,000 in the S&P 500 in 1980, it would be worth over $20,000 today, thanks to an average annual return of approximately 8%. That's the power of compound interest. Small amounts given enough time can grow exponentially. Making money and keeping money require different skills and mindsets. For instance, consider the difference between a high-earning celebrity who squanders their fortune and a frugal entrepreneur who steadily grows their wealth. The former may have a higher income, but it's the latter who often ends up financially secure. Wealth accumulation is not just about earning, but also about preserving. Sometimes it's the rare, unforeseen events that have the most significant impact on our wealth. Take Bitcoin, for example. A single investment of $100 in 2010 would be worth millions today, all because of a tail event that few could have predicted. These outliers remind us that rare events should not be ignored in our financial planning. True financial freedom is not about having a specific amount of money. It's about having control over your time. It means your lifestyle isn't dictated by financial constraints, and you're not tied to a job you dislike because of the paycheck. It's the ability to say no to things that don't add value to your life and yes to the things that do. Financial freedom is the ultimate goal for many, and it's about much more than just dollars and cents. Hey, before we continue, if you're finding value in this journey, do leave a comment with which lesson you found most interesting. Now, imagine driving next to a luxury car at a traffic light. You might think that driver is wealthy, but the truth could be far from it. The man in the car paradox teaches us that wealth is not what we see. The luxury car might be leased, or the driver could be drowning in debt. True wealth is not about the display of assets, but about the assets we don't see, like investments and savings that don't make for flashy status symbols, but do build real, lasting wealth. Building on the previous point, wealth is the financial assets that don't make it to Instagram. It's the money saved and invested, not spent. It's the old car driven for years, allowing savings to compound. It's the modest house that frees up income to be put into the stock market. For instance, a study showed that the majority of millionaires are actually self-made and often live in average neighborhoods, drive older vehicles, and avoid a lavish lifestyle. The importance of saving cannot be overstated. Saving money is the surest way to financial security. Historical data supports this. Those who persistently save a portion of their income, even small amounts, are better prepared for emergencies and retirement. For example, if you save just $5 a day from the age of 25, assuming a 7% annual return, you'd have over $500,000 by the time you retire at 65. In finance, being reasonable often beats being perfectly rational. Rationality suggests you should always make the choice that leads to the highest financial gain. But reasonable behavior accounts for personal values, goals, and the reality of changing circumstances. It's like choosing a slightly lower-paying job that you love over a higher-paying one that makes you miserable. The reasonable choice leads to a better overall life satisfaction. The financial world is full of surprises. Just look at the 2008 financial crisis or the COVID-19 pandemic. No one predicted their profound impact on the global economy. These events remind us that the only certainty is uncertainty itself. Preparing for the unexpected is not just wise, it's essential. Having a room for error or a margin of safety in your financial plan is crucial. It's like wearing a seatbelt. You hope you won't need it, but you're glad it's there when you do. Financial buffers can protect you from life's inevitable shocks. For example, during the 2020 market downturn, those with an emergency fund were able to weather the storm without selling investments at a loss. Our financial needs and goals are not static. They evolve as we move through life stages. When you're young, we might prioritize saving for a car or a first home. As we grow older, our focus shifts towards family needs, education for our children, and eventually retirement. For example, a study showed that our financial objectives shift from accumulation in our early years to preservation as we approach retirement. This evolution is natural and reflects the changing priorities and responsibilities we face. It's why a flexible financial plan that can adapt over time is so crucial. Every financial decision comes with a cost, whether it's the interest on a loan or the opportunity cost of choosing one investment over another. Understanding these costs is key to making informed decisions. The cost of capital, for instance, is a critical concept that measures the return needed to justify an investment. It's the hurdle rate that any project must overcome to be considered worthwhile. This principle applies to personal finance, too. Every dollar spent or invested carries the weight of this cost, shaping our financial future. Money is a universal medium, yet it speaks a different language to each of us. Our views on money are as varied as our fingertips. Some see it as a means to an end, others as an end in itself. These differences extend beyond individual behaviors to generational and cultural divides. Each generation, from baby boomers to Gen Z, has been shaped by the economic climate of their formative years, influencing their attitudes towards saving, spending, and investing. Culturally, the value and use of money can vary dramatically, affecting everything from business negotiations to personal relationships. To illustrate, let's consider two hypothetical characters: Emma, a millennial freelancer who values experiences over possessions, and John, a baby boomer who equates wealth with security and success. Emma prefers to invest in travel and learning, while John focuses on accumulating assets and increasing his net worth. Neither perspective is wrong. They're just different reflections of their values and life experiences. Understanding that there's no one-size-fits-all approach to money can help us make more inclusive and empathetic financial decisions, both personally and professionally. Pessimism often wears the disguise of wisdom. It sounds smart because it seems prudent and cautious, but beware the seduction of pessimism. It can be costly. Pessimists grab attention by pointing out risks and flaws, which can seem like a call to action. Yet this negativity bias overlooks the progress and opportunities that optimism harnesses. For example, during the 2008 financial crisis, those who succumbed to pessimism and sold their stocks missed out on the subsequent market recovery. which saw the S&P 500 climb from a low of 676.53 in March 2009 to new heights over the following years. Optimism isn't about being naive, it's about recognizing the potential for future breakthroughs and growth. Financial gullibility can lead to disastrous consequences. It's a form of induced social risk awareness, where one fails to anticipate the risk of being swindled. Take the famous African Prince 419 scams, which prey on the gullible with promises of large inheritances in exchange for a small processing fee. Victims of these scams are often lured by the prospect of quick wealth, ignoring the glaring warning signs. To combat gullibility, you must foster skepticism and due diligence. Always verify information, seek second opinions, and remember, if it sounds too good to be true, it probably is. Hey, as we close this chapter, the overarching message of Morgan Housel's book is clear. Understanding the psychology of money is key to making wiser financial decisions. It's not just about how much you make or save, but how you think about each dollar that passes through your hands. Remember, wealth is not just about the balance in your bank account. It's about the freedom it affords you, the security it provides, and the choices it enables. It's about finding a balance between enjoying your wealth today while planning for tomorrow. So if you've enjoyed this exploration into the psychology of money and want to continue learning and growing with us, subscribe to Fun Financial Insights and tell us what lesson resonated with you the most. Go ahead and comment down below with your own experiences and insights, and we'll see you in the next episode.